Assalamu alaikum. Sir, my name is Zishan, and along with my partner, Mr. Ejaz, we have conducted an empirical analysis for the topic determinants of exchange rate volatility in Pakistan that covers the turbulent economic period from the year 2020 to the year 2025. Sir, while we often hear about exchange rate in the news, our goal today is to move beyond the headlines. We have quantitatively assessed exactly how much inflation, interest rate differentials, and foreign reserves drive the value of rupee using a multiple linear regression model. So starting with the inflation and background, the main problem uh, is between January 2020 and June 2025. The Pakistani rupee didn't just only fluctuate, it experienced a structural shift. We saw the currency depreciate from around 155 rupees per dollar to exceeding more than 300 rupees, essentially losing half its value. So, for a developing economy like Pakistan, this isn't just a monetary statistic, it is a livelihood issue because we have heavily dependent on imports for energy and raw materials. Every rupee of depreciation feeds directly into domestic inflation. So this creates what we call a vicious cycle of monetary instability. Our research objective was to break this cycle down into numbers to identify not just what causes depreciation, but exactly to what extent each factor is responsible. Now coming to the third slide for our key variables. So we have collected a data set from 66 months of observations. So we looked at three specific independent variables that were sourced from the State Bank and the Pakistan Bureau of Statistics. The first independent variable was the interest rate differential, that is the gap between the State Bank policy rate and the US Federal rate. The second was inflation, which showed the data of which showed extreme variance, peaking at about 38% during the supply side shock of the year 2022-2023. And the third one was foreign reserves. So our dependent variable was the monthly average exchange rate, and that averaged at about 225.43 rupees over this 5-year period. Power parity, which is there was a positive relationship between the domestic inflation rate and the exchange rate, meaning that higher inflation leads to higher depreciation of PKR against US dollar. The second hypothesis was asset market approach. There is a negative relationship between the interest rate differential and the exchange rate, meaning a higher domestic interest rate relative to the US attracts capital that will appreciate the currency against the US dollar. Okay. The third hypothesis was supply and demand. There is a negative relationship between foreign exchange reserves and the exchange rate, meaning higher reserves indicate higher supply of dollars, leading to appreciation of Pak rupees against the dollar. Top right of the slide, let us come to the first variable, that is our dependent variable. So it shows that the exchange rate of pulse, the total observation weighted for rates. Output came as 225.438. So this means that during this period, the average dollar P against the standard deviation is 55%, which is very high, which indicates extremely instability in the currency during this time period. The range that is minimum to maximum is 152.28. To this means the rupee depreciated massively during this period. It started with a strong rate that is 152 and crashed to as low as 307 per US dollar, which shows high severity of the currency crisis during this period. So now coming towards the first dependent variable, the interest rate differential, the mean is 9.77. That on average, which means that on average, Pakistan's policy rate was about 9.77% higher than the US federal funds rate. In the range, the minimum to maximum 3.7 to 17.47, it shows that a State Bank of Pakistan was likely hike the rates aggressively to combat inflation and defend the currency. Now, the third variable, inflation rate, the mean is 17.6, which means that average inflation was quite high at 17.6%. The maximum for this was 38, which means that the inflation peaked to the rate of 38%, which confirms the severe supply side shock in economic crisis during the period of 2020 to 2025. The standard deviation for this was 10.37. Inflation wasn't just high, it was not predictable. It, it was unpredictable. The large standard deviation proves that the prices went out of the reserves in that reflected the data in billion dollars. The mean is $14.62 billion on average, with the minimum going to $4.4 billion, which is dangerously low, and likely corresponds to the point of maximum vulnerability at to be solved. And the maximum, that is $27 billion, shows its peak when Pakistan had a much healthier buffer. This was the first chart on top right. Now, so coming towards the second chart that is shown or from the output statement, it is on the 415. This is the goodness of it. This means that our model was uh, of the fluctuations in the exchange rate was about 84.15%, which is very high for macroeconomic data. And this means that we have successfully captured the vast majority of factors driving the rupee. Second one, the root mean squared error. On average, our model's predictions are off by about 22.47 rupees, which can be due to the high volatility during this period. As you can see in the above table, we have mentioned the standard deviation was 55. In our opinion, this was coming towards the bottom side of that same table, uh, the coefficient of variable x1, it is minus 2.1504. Negative, meaning we have a negative coefficient. This means that if the interest rate gap widens by 1%, the rupee will strengthen by 2.15 rupees because of the negative relationship. The p-test, it is the p-value is 0.013. Well, this is significant and it is less than 0.05. This suggests that while the interest rates better, they are weaker tool compared to the other two. Coming to the second variable, x2, the coefficient is positive 3.3, which means that 1% increase in inflation, the exchange rate also rises by 3.3 rupees. Here the p value is 0. This is This result is, if you say, statistically very significant, which means that about 99.99% confidence is there. So, what we need to say is that inflation is undeniably a driver of depreciation in market. The coefficient is again negative, minus 3.52. Uh, this means is for every 1 billion increase in reserve, the exchange rate drops by 3.52 rupees. Here also our p value is zero, which is again very significant with a confidence level of 99.9%. Uh, the coefficient of the constant is 239.54. So this means that if mathematically, if inflation, reserve, and interest rate differentials were all zero, which is in reality, which is impossible, the baseline exchange rate would be 239.54. Visualizing the relationship with the chart, the charts, read the charts, the steep on the first we'll go with the chart on top. The top chart, it is a steep positive slope between inflation and the exchange rate. Here the correlation is very strong at 0.785, and this validates that domestic price instability is the primary driver of our currency strength. Now coming towards the second chart or the second graph on the bottom, we see a negative relationship with the foreign reserve, where the correlation, as we discussed in the previous slide as well, the correlation is negative. So this means as the reserves on the x-axis dry up, the exchange rate shoots up. This confirms that reserves act as the scarcity premium on the dollar. Wherever OLS estimators are valid, so we run the diagnostic first newspaper. Obviously, with the coming towards the charts, the multiplinearity we check with the variance inflation factor. Our mean inflation factor was 1.75. That is well below the threshold of 10. So our variables are distinct and not merely mimicking each other. Secondly, the heteroscedasticity test gave us a p-value of 0.0423. This is slightly below 0.05, which means that heteroscedasticity or changing variance in the error. Now, the last, uh, this is expected in financial time series due to the volatility clustering during crisis periods. While our coefficients remain unbiased, the future research could improve efficiency by using robust standard error or a GART model.